Today we're going to learn about how to calculate break-even point. What is a break-even point? It is the stage where the company's revenues equals its costs. The calculation for the break-even point is done to determine the amount of units that need to be sold or the amount of sales that need to happen. Break-even point allows a company to know when it or one of its products will start to be profitable. If a business's revenue is below the break-even point, then the company is operating at a loss. If it's above, then it's operating at a profit. The first step is to separate a company's costs into those that are variable and those that are fixed. Then use the following formula. Fixed costs divided by the difference of sales price and variable costs. Fixed costs are costs that do not change or change only slightly. Examples are monthly utility expenses, rent, or loan payment. Selling price is how much a company is going to charge consumers for just one of the products that the calculation is being done for. While the variable costs are the costs directly tied to the production of a product that often fluctuate and are typically a company's largest expense. For example, labor and the costs of the materials used. Note that the fixed costs are stated as the total of all overhead for the firm, whereas price and variable costs are stated as per unit costs, the price for each product unit sold. For better understanding, here is an example. The ABC restaurant, which sells only pepperoni pizza, has the following expenses for the whole month. Their total fixed costs is $232,500, while their total variable costs is $315. If they charge 415 pesos for the finished product, then they receive 100 pesos per pizza to contribute to the fixed costs and ultimately the restaurant's overall profits. We can now calculate the break-even point by dividing the 232,500 by the 100. This means that ABC restaurant needs to sell just over 2,325 of the pizza in a month to reach the break-even point.